I made over $5 million in just a few short years using this super simple trading strategy. So by the end of this video, I'll be giving you the exact same system that took me from a broke dead-end 9 to 5 to multi-millionaire within just a few short years. So you yourself can make 6, 7 or 8 figures this crypto bull run. And it doesn't matter where you are on your trading journey, all the way from beginner to expert. I can guarantee you, you will learn a lot. So grab a pen and paper and take notes because this system will change your life. Let's get into it. This was me, BTC, 7 years ago, working a 9 to 5, making £2,000 a month, barely getting by, stuck in the rat race, and I was not enjoying life at all. And this is me now, 7 years later, doing what I want, when I want, because of the information that I'm about to give you and then implementing it. I've been in this industry for many years now, and I've seen and made every single mistake in the book, and I've learned from it. And that's what's been able to make me millions of dollars. And one common mistake I see people make is searching for that one setup or that one perfect system that they think they can just look for and then become rich. But this couldn't be further from the truth, because if that was the case, then I could just put this trading system into a trading bot and it would just print money forever. But it doesn't work like that. The markets are always changing. Volatility is always changing. That's why we go from one market condition to another. And then these bots work for a short period of time and then they fall off the face of a cliff. It's like this. Imagine it's a boxing match and you see the same jab, cross, hook every single time with no variation. It would be so easy to win and make money. Everyone would be billionaires. But this does not happen. In the markets go from bull market to bear market to going sideways. And you need to trade each and every market condition very differently. That's why you see so many people in crypto make loads of money, but then they give it all back because they fail to identify one of the key things that rules the entire markets: context. Context is what I use to predict the exact top in 2021. Context is the exact same method that I used to predict the bottom in 2022. And not only does this strategy work technically, it has allowed me to pick many coins this cycle that I have shared that have already done 10 to 20x returns, like FET and Pepe, for example, giving you the golden formula of fundamental analysis and technical analysis. So that brings us to rule number 1, key support and resistance. Let me break down how to pick good support and resistance levels and actually how to trade off them. Whether you're a complete beginner or an intermediate level, you may already think you know how to pick a support and resistance, but this will completely change what you know about this concept because many people teach you incorrectly. And I'm going to teach you this as simple as possible. Again, I'm going to come back to the boxing analogy. Everything stems from the jab, but everyone wants to focus on the haymakers and go for the big knockout straight away. Like football too. Everything stems from how to pass, but everyone wants to look how to do an around the world or how to have the best bend it like Beckham. Or in coding, you start from focusing on clean coding practices so it's easier to read further on down the line. Then to become a master at something, everything stems from the fundamentals. Then once you've done this, you add a little bit of flair, your own spice, and your personal touch. So, how do you identify a support and resistance level? A support and resistance area is just a point in time that pushes price away in both time and distance. That's simply it. The reason being is because there's usually quite a few sellers and buyers in that region. So what is a support and resistance? A support is a floor in price and a resistance is a ceiling in price that pushes price in both time and distance. But we want to dive on a deeper level. So we ask ourselves these questions. What kind of reaction has this level given in the past? Is it a small reaction? Is it a large reaction? How is this level relevant to the current price action? Because there's absolutely no point in using and looking at a level that is just too far away, nor use a level that is already used up and is no longer relevant. It's chopping and trading through the level. So then you ask yourself, what is the probability of this level holding? For example, you want to buy support, but if you don't think the level is going to hold, then there's absolutely no point in buying that support. So now, as you can see, if you ask a series of questions, you now put the odds in your favor. And that's exactly how I maintained a 90% strike rate in the 1 to 100k trading challenge that I completed in my Discord. Because instead of a trade being 50-50, you buy a support level and it goes up or it goes down, that's 50-50. You now stack the probabilities in your favor to higher probabilities, depending on how many factors are in your favor, which we'll cover over in the next points. But for intermediates, the issue is people tell you different things. But at the end of the day, any block or gap that you may have learned of in the past is really just a form of support and resistance. It's just an area for a price to reverse. I personally think that blocks and gaps are just there to overcomplicate your trading, because you can always argue, is this an inverse gap, or is this a breakaway gap, or, you know, blah, 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 any other type of gap. But we're here to make money and predict where price is going on the charts, not argue about terminology. All of these blocks and gaps are just SR, and they just push price away in time and distance. At the end of the day, you can't argue what an SR is. It's concrete. But the problem does arise when we want to anticipate whether we think this support or resistance level is going to hold or break through. But as I just said, you can always ask yourself these series of questions, whether you think the support or resistance will break or not. But if the support or resistance does break, then remember this. That first touch of that support and resistance is always the strongest touch. And let me show you. As you can see here, we're on the charts now. This is support. If we drag this across, support there, pushes price away in time and distance, breaks back below, pushes price away in time and distance. Resistance, a little bit of chop, but once we get back above, support pushes price away in time and distance. Then we come back down here, support, support, support. All of these levels here push price away in time and distance. So time and distance, time and distance. Then this time round, as we have many touches, as I said, the first touch is always the strongest. Sometimes the second is also strong. After a third or fourth or fifth time, it gets significantly weaker. As you can see, lower high, we get become less time and distance as it goes on. Then once we break through, this first touch here is the strongest of the underside retest. So as you can see, support turns to resistance here. And this here is the first touch, and it's usually the strongest. Okay. So that's support and resistance. And you can see that's on Euro USD. This works in all markets, Forex, crypto, S&P 500 commodities. This will work on other coins, other assets like orange juice, cocoa. Look, it literally works on anything, all of them. And if you want to be boring, it can work on like the Bund and weird other financial things like that. But this works very well across all assets. So as you can see here, we have a support, bounce in price, not that much time and distance, but it still pushes price away. We then have resistance here, turns to support. So all of these trade examples that I'm going to give you in here are trades that I've taken in the past. So this here is a Bitcoin long that I took inside my private trading community. So every single trade in this is going to be from an example that I have taken. So, and as each point develops, you'll be able to see that how the strategy forms together. So this is first of all SR. That's what we need to identify first. So as you can see here, resistance here turns to support. This was where I was buying longs, and the same again here. The same on ETH. You can see here, pushes price away in time and distance. Once we break back below, the first touch is most significant, pushes price away in time and distance, pushes price away in time and distance. Once we break back through, pushes price away in time and distance, and as you see, this is now support again. Now I have got a box here. We can also draw lines, and that does also work. So there we go. But I've just, in this instance, I've used a box to make it a little bit clearer. But as you can see, resistance there, resistance there, resistance there, resistance there, turns to support there. Big time and distance away. So when you're trading with the levels, just remember this. The markets are a bit like an ocean, and you can't control them, you can't move them, they're just simply the markets. This is for a future topic, but one key thing to note here is that price likes to follow the path of least resistance. So you always ask yourself, how strong is that level? And this is a very extensive topic and I have a lot more to say, but I cannot fit this all into one video. But what I have given you is as much as you need to know to improve your trading. And that brings us to rule number 2, market conditions. Now, this is so important when deciding which strategy to apply, because this is what you see very few traders talk about, because most of them are quite one-dimensional and they think that markets always move the same, but they don't. Some market conditions suit people differently and some people better. Some market conditions are more volatile, some market conditions are more calmer, and this is how I was able to make $5 million within a few years of trading, because I pivot my trading strategies depending on the market condition we're in, so I can make money all of the time. Whereas this is how so many people lose their money trading, because they think they've cracked the market conditions. For example, like a bull market, they double down on their strategy, and then when the bull market ends, they give their money back to the markets in a different market condition, and they just fail to adjust. But luckily for you, there are only 2 market conditions that you need to learn, and I'll teach you how to identify them and how to trade on each one of them. So market condition number 1, we have the range. This is where price is trading sideways between a defined high and a defined low. For example, between a support and resistance level. Remember, floor and ceiling of price. And in this market condition, price always likes to come back to the middle, and we only trade at the highs and the lows. Now, there are certain conditions that we do trade in the middle, but most of the time we trade at the highs and lows. Like, there are some times that we do trade in the middle. So you identify a range when each swing point is not going higher or lower. As you can see here, this is a swing point, as it's a turning point in the market, swing point, which swing points build up at a support and resistance level, giving you that push away and price away in time and distance. And a touch of an SR is just a swing point in the markets, as I just said. So you master this, but there are a few variations of the range. As I said, that we will save the midpoints for later. So how do we actually trade the range? Okay. So when price is ranging, we are stuck in an area of value. So when we head to the lows, we look to buy because this is considered cheap. This trains you to buy support. When we head to the highs, we consider this price expensive because we're stuck in the range. So we look to sell this and you short. This trains you to sell resistance. In this trading environment, you need to take profit aggressively because we trade the fake outs, which is price likes to fake out and then comes back inside, which is part of the execution, which is later on down the line. But this is when price slightly breaks out of the range. You think it's going to continue higher, but then it fails and then it goes to the other side. That's a trading opportunity. Very much like this, comes outside, once it gets back inside, then we head to the other side, okay? You trade the range tops and the bottoms, so you only trade the extremes of the range, the highs and the lows. This gives you better risk to reward ratios, which we'll also cover a bit later on down the line. And as I said, you need to take profit aggressively. Otherwise, the reason being is because you may round trip your profits. What happens quite often in a range, people short this high, or they buy this support, the price goes up, they keep holding, thinking price is going to go higher and higher and higher, then it doesn't, and then they round trip all of their profits. So in a range, you take profit aggressively. Here are 2 trade examples of when price was in a range, right? So this was both were on Bitcoin. This ranging environment works in all markets. So the difference between crypto and Forex is that crypto ranges and then trends, and it trends a lot more. Whereas Forex ranges 80% of the time. It ranges more than any other market. So some markets range more, some markets trend more, and this is why we like crypto. But the trend is on the next point, so we'll cover that in a minute. Here is a trade that I took on Bitcoin. I can't remember how much I made on this trade. I think it was about $30,000 to $40,000, but I'll attach it in this video. So this was a range here. As you can see, we're trading within a defined high and low. As you can see, we aren't making any higher highs and higher lows. Each swing point is just in a range, right? We're trading between a ceiling in price and a floor in price. Once we broke down here, I wasn't expecting continuation, which is points further on. But once we get underneath, we then get back inside, which is the fake out that I was talking about. Once we get back inside, there is my trigger to go long, and then we headed for the highs. That was my trade idea on Bitcoin. But as you can see, how I came about it, because it came into a key support level, and we were in a ranging environment. Trade number 2 was on Bitcoin here. So I gave this trade idea here. And as you can see, we were in a range-bound environment. We had already come from a trend, trending. We were coming into a range-bound environment where we weren't making any clear defined highs or lows. But what happened was that this was the first area of support, right? Support here, pushed price away in time and distance. So then as it came down to the lows here, we took our longs in this region here. So as it came underneath this SR, got back above, there was our trigger to go long, as per the video that I posted inside the Take Profit Collective. There was our trigger to go long. We put our stop loss below the low. As you can see, we traded up into there, take profit 1, and then we took profit into this resistance area here, to the other side of the range, as you can see here. So this was a resistance area, and that's where we took profits on our trade. So that is the range-bound market condition. And as I've already said, market conditions do not last forever. So if we have consolidated in a range for a long period of time, we are due for expansion. Which brings us to market condition number 2, the trend. Remember when I said if it stayed the same forever, it'd be easy? And this is exactly what I'm on about. In simple terms, the bigger the consolidation, the bigger the range, the bigger the expansion. And that's where we get into a trend. This is where price trends upwards or downwards in a consecutive manner. In this market condition, you usually see increased volatility, which is exactly what you see in bull markets in crypto. And a trend only moves in 2 ways. In an uptrend, we make higher highs and higher lows. And in a downtrend, we make lower highs and lower lows. So, as you can see here, price makes a low there, we make a high, we make a higher low, which is higher than this low, and then we make a higher high, which is higher than this high. And then we make another higher low, and that's a trend. That's an uptrend, okay? And in a downtrend, this is how it works, right? We make a low, we make a lower high, or we make a high, we make a lower low because this low here is lower than this low. Then we make another high because this high here is lower than this high, and then so on and so forth, lower highs and lower lows. So how do we identify that we're going to start to trend? Because when price has consolidated for a long period of time, instead of selling the highs, you can trade the breakout of the range. For example, we have range for a period of time. Instead of selling this high here, instead of selling this high here, we look to buy the range breakout. And then you can trade this market condition by buying the breakout of the range or getting in on pullbacks of the trend. So as you can see here, we've ranged, we break out. This is the pullback. We trend higher, then you can buy this pullback here, and then price continues higher, which is a trend. Higher, higher low, higher high, higher low, and continuation. And then you need to hold your positions in this market condition. Unlike the range, where you take profit aggressively, this is where you hold onto your positions for those bigger gains. And this is an example of one of the trades that I was able to catch earlier. And this is how I was able to catch a 10 to 15x on FET. So as you can see here, this is FET. Number 1, we start off with an SR. As you can see here, price gets pushed away, a little bit of chop, comes down, price is getting pushed away in time and distance, we break above, look at this, price gets pushed away in time and distance, price gets pushed away in time and distance, price gets pushed away in time and distance. Again, it's now resistance. We then break out, we come back down, the first touch here is always the strongest, then we start to range holding this SR level. As you can see, we're ranging here. This was where I was doing all my buying on FET. My main buys were under 20 cents here. And as you can see, when price breaks out of this range, we get the expansion. We make higher highs and we make higher lows, as you can see here. Higher highs and then higher lows until we reached the ultimate 10 to 15x on this coin. So I've caught many of these coins over the years, but this is an example of how the market conditions change in this example here, as we went from a range here, consolidation, and as you can see here, we broke out and we started to trend upwards. So to conclude market conditions, your job is to identify which market condition we are in and trade accordingly to that market condition. Which brings us to point number 3, top-down analysis. I see so many people try to just jump straight into the charts on the 5-minute time frame, trying to day trade or scalp the markets. 1 or 2 losses later, you're trying to get back to break even, and now you're stressed, and now trading becomes even harder. And then you make mistake after mistake. What I'm trying to teach you here is to spend as little time as possible on the charts, but make as much money as you can while avoiding all of those small losses. So what top-down analysis is higher time frame analysis and then lower time frame execution. This means that we analyze on the higher time frame and then we execute on the lower time frame. Because at the end of the day, the higher time frame is king. Because if we don't know where price is going to go on the higher time frame, then you're probably going to struggle where price is going to go on the lower time frame. So what I teach is that we go from the monthly to the weekly to the daily to analyze. Then we move down onto the 1 hour and 15 minute to execute on the trades. We can go a little bit lower with more experience, but this means that by picking higher time frame levels, you increase the odds of being correct on that trade idea even more, because a daily or a weekly support and resistance level is going to be much more stronger to hold than a 15 minute time frame level, because on a daily and weekly time frame, there is a lot more volume traded into those higher time frame levels compared to a 15-minute level, which means it's going to have a higher probability to hold. Then we learn to execute our trades on the lower time frame, which increases our risk to reward ratios to make us more money. Now, I do cover this in great detail on my weekly live streams that I do on YouTube and in my private trading community, but essentially here, I'm going to go over an example and why we want to increase our risk to reward ratio and how this helps, right? So as you can see here, this is the risk to reward ratio. This here is your win rate percentage. So how often are you right? Let's say if you take 10 trades, you're right 5 and you're wrong 5, that means you have a 50% win rate, right? So that would be smack bang here. But if you take trades with a 1 to 2 risk to reward ratio, then you'll make money, right? If you take trades with a 1-to-1 risk to reward ratio with a 50% strike rate, you'll be break even. Anything in the red here is you losing money. Anything in the green here is you making money. Essentially what we want to do here is obviously be in the green, but we want to give us as much breathing room as possible. So we want to be, ideally, in a perfect world, we would want to be down here. But humans aren't perfect. So what it is we can aim for, I hit a 90% strike rate in the 1 to 100k trading challenge. So we would be here. But realistically, I think aiming for around 70% strike rate, 80% is very good. Some people say 50% is good, which is true, but it means you have to hit these higher levels here. I like to push on the, say, 1 to 4s, 1 to 5s, and then hit this kind of strike rate because it gives you a bit of breathing room. If you lose one trade, then you can still make money. So let's break down this top-down analysis on the chart here. Remember the trade idea in the range-bound market condition? This is my Bitcoin trading setup and how I came to that using top-down. So we'll start off with number 1 on the monthly time frame. Remember, we analyze on the monthly and the weekly. This isn't the SR, the level that I've been looking at for absolutely months now. But the reason being is because let's go down on the weekly, okay? Weekly here. As you can see, this level here pushes price away in time and distance. You can see this is where we first found resistance here. Push price away in time and distance. Resistance, we faked out. Once it got back below, this pushed price away in time and distance here. We got back above it here, pushed price away. Let me go down on the daily now. Then once we got back below this level, look at this reaction here. huge reaction, pushes price away in time and distance, time and distance, time and distance. Then once we break back above it again, this is the support level. Okay, so as you can see now, this is the support level. And as we had already trended, so number 2, what market condition are we in? Okay, we had just trended for a long period of time. The trend that I caught these longs from down here and down here. So we trended up, trended up, trended up. Then we weren't making any higher highs and higher lows. We were kind of in an area of indecision into a key SR. So key SR, market condition, range bound. Okay. So then we go down on the 1 hour time frame to execute the trade. And as you can see here, this is support here, comes down into this support here. Once we get back above, that proves to me that we are in a range bound environment. This is where you can take your longs up here, stop loss below the lows, and then this is where we head higher. So that is top down analysis, how we use the higher time frame and work all the way down to the lower time frame here. You can go a lot lower, 15-minute. But as you can see here, this is how you would maintain a very small stop loss. So there's your range breakout into a 1 hour trend, right? So this is how we have now used the higher time frame in the monthly levels to find strong support and resistance levels. And then we move down into lower time frames to actually execute our trades and maintain a great strike rate with a great risk to reward ratio. Now you can start to notice each one of these factors of confluence are starting to stack up on top of each other. And that's all trading is, stacking concepts and probabilities in your favor that validate your idea of being correct. And then you find arguments for how you could be wrong. And then you come to a conclusion and then execute the trade. If you have less arguments for you being wrong, then that's probably a good trade. But many traders don't actually think of the market this way. Instead, they get trapped in poor positions based on emotion. But this is great for us because we can take advantage of these traders and we can make money off them using liquidity. Sometimes the market gives you the most obvious bait, like fishing, and you put your line on the worm and then you throw it out to sea. Just like the fish taking the bait is like the traders taking the bait in the markets. And this is exactly what point number 4 is, liquidity. It's where people get trapped in the markets, whether by poor stop loss placement or by trading the wrong market condition. How many times have you entered a trade and it's hit your stop loss, only for then the market to rally in your direction and move in your favor? When this happens, you are the liquidity because you've been forced to close your position and you're trapped, and then price moved in your favor anyway. For example, let's say if you think price is going to break out, we're in a range in a bear market before the start of a bull run. Price makes an attempt at the high to make that breakout, but we remained range bound. You've longed to the top of the range, expecting a breakout, but then price moves hard against you because many of the same novice traders thought the same way. What actually happened here was liquidity was engineered at the highs. The fish took the bait. For example, when we start to break out and then it gets back inside, this, like here, we start to break out, it comes back inside. Here is where longs are forced to close because you've longed out here, price gets back inside, and it's now going against you. You're underwater, you're trapped, you're stuck in a position that you don't want to be in. And this is where you're forced to sell. And price trades through the level, triggering you to buy the breakout, etc., gets back below, and this has now triggered a wave of liquidity. The same on the other side. If you buy support, comes down, you put your stops to break even, or you get stopped out, that means you're forced to sell, and then price goes higher, and then you have to chase price. So there's two kind of ways to think about this, right? You could sell this resistance here, you put your stop loss at X, it comes up, triggers your stop loss without you, and then it goes lower. Or on the other side, you buy this breakout and then it goes back below, and then now you're underwater, forcing you to sell here, causing now more pressure, okay? So that is liquidity in a range, right? So you have the high here, you make a higher high, etc. So I've got so many examples of this, so let me find one. This is an example on Bitcoin where I took the trade. Exactly, remember the support and resistance area earlier. I actually made over $100,000 on this trade, pretty good. So we had the higher time frame resistance here, time and distance away, time and distance away. And if we go from the weekly time frame, right, let's zoom out, let's do it all. So we're stacking concepts up, weekly time frame, we've got an SR level here. So imagine we haven't had this retest yet. Resistance here, we've broken out now, and now I want to buy support. Okay, simple as that. So we've had a range here, we've had a breakout, we've had a retest. Okay, so that's the range. The range is here. There we go. We've had a range, we've broken out of the range. Now we've had the support test here, and then we have another area of liquidity here. So this is the target, so we can use liquidity as targets, but again, that's for another video later on down the line. But we've broken out of this range into support here, so then we break it down on the daily time frame. Okay. So then this is our level here. This is our range. As I said, we had the liquidity in a range. We come down, we take out the lows, gets back inside, which is the same as this example here. We have the lows, comes down, gets back inside. There's our trigger to go long, and we head higher. So that's exactly what happened here. Let's go down on the 1 hour. It took me 2 attempts of this trade. So I did 1 attempt and then 2 attempts. As you can see here, we had 1 stop run. That was where I bought. Then we rallied up here. Then once we broke down the range, that was the real breakdown into a key SR level. Then once we got back above, that was my trigger to go long here, trigger to go long there. Because many people here started short in the markets. They got bearish because, oh, we've ranged here. We are now breaking out of the range, right? And initially, I bought here. Let's say my original long got stopped out at break even. Then if I didn't re-enter, I would have to chase the market higher. But because I got stopped out at break even here, and then because of using this strategy, this doesn't happen that often. So when price has done its stop run, people are now bearish down here. It comes back above. People are shorting, generating the liquidity. It gets back above. There's my trigger to go long. Stop loss below the lows, and then we head higher. And this is how I was able to catch a $100,000 trade off of this move, maintaining a very tight risk to reward ratio. So this is how to trade liquidity in a range. Then we also have liquidity in a trend. This is very different because obviously the market conditions move very different. So in a trend, what happens is you usually get a markup, you consolidate, you then have a low, you then take out this low, and then price heads higher. What does this look like? We'll zoom in. So we zoomed in here, we have the trend, we make a high, we make a low, we make a higher high, trapping liquidity here, and then price comes down, takes out this low. People think that this trend has ended. Oh no, we're really bearish now, but what happens is it gets back above, and then price continues higher. Very, very similar to a range, but it's in a trend, right? So another example here. So now we're making our higher highs, higher lows, and then we have another range in here. So we've gone from a trend, into a smaller range. So as you can see here, people are long, 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 long. And what happens is that people who are late to longing this are now trapped. So they long up here, thinking that the market's going to continue higher. It pulls back, forces them to close their late longs. So late longs are now wrecked. Then once price gets back inside, there is our trigger to go long. Stop loss below the lows, and then price continues higher. So as you can see here, many people put their stop losses thinking that the market condition is going to go higher highs and higher lows, right? So higher highs and higher lows like this. So people long here and they put their stop losses below that. The most obvious stop loss, right? Thinking that the market is trending up with higher highs and higher lows. So what happens here is that price comes down, it sweeps that low there, it makes you think it's making a lower low, but no, market structure is still making higher highs and higher lows. It then gets back inside, that's your trigger to go long, and then we head higher. So that is liquidity in a range and liquidity in a trend. One thing to note here, and one key takeaway, is that note, not everything is a stop run. We don't need to be always, this is a stop run, that's a stop run. We are just looking at the most obvious stop losses and the easiest areas of liquidity. As I said in my analogy, sometimes the market gives us the most obvious bait, and that is what liquidity is, obvious bait in the markets. If you're able to identify the liquidity and where traders are trapped, then by definition, you can enter the markets. Because if somebody is trapped in a position they don't want to be in, then the market should punish them hard and go against them. Which brings us to step number 5, or rule number 5, execution. When you enter a trade, ideally you want a price to move away from you as fast as possible in an ideal world. So let me break down one of the many entry and execution techniques that I know that has made me millions. I'll be making a video in the future covering different entry techniques that made me $2.5 million in just over a year. But in this video, I will cover the main entry technique called the failed breakout or breakdown. This works in both bullish and bearish scenarios, and we can use this to also anticipate a range and in a trend. So how does this setup work? What happens is we have a support level, as you can see here, support level, price bounces. What we wait for is the previous swing high or swing low to get ran, like this. Then once it gets back inside, that is when, and holds, that is the key, holding, as you can see, support here, failed breakdown. We are failing to break down. Then once it gets back inside, that is confirming to us to enter the position. We enter there. Then where our stop loss should be below or above the swing high created. So as you can see here, this is support. We've broken down as a failure of a breakdown or a breakout. This could be called a fake out, deviation, any of those kind of words, right? But I like to say failed breakdown, failed breakout, because it is failing to break down. Very simple. As it gets back inside, that is our trigger to go long. Our stop loss should be below this swing low, because this here should confirm to us that the low is in. We want to buy when the low is confirmed. We don't want to buy in a downtrend, so we want to wait. We want to wait and see the low being confirmed. Once the low is confirmed, that is when we enter the markets, and then that is when the markets push higher. So let me break this down into an example for you. Remember this same Bitcoin example, right? We're going to use all of them put together now, okay? So this is the same trade that made me over $100,000 in a single trade, right? Let me zoom out on the monthly time frame, okay? So we were here. We consolidated in this region here for a long period of time. As you can see, this here is when we consolidated all the way to here. 273 days of consolidation. That's a very long time on Bitcoin. So then we go down on the weekly time frame. As you can see here, this was my initial low call on Bitcoin when I called the bottom of the crypto markets. So once price gets back inside, that was the long, to the other side of the range. That's a range, right? We've got very, very clear range here, which is also giving us clean SR. So step number 1, SR, big swing move, time and distance away. Number 2, we are in a range here. We've just broken out of the range, okay? We're here. Number 3, top down, which is what I'm doing here. We move down. We can refine this level here. So as you can see, this is the first week. We wicked that one, move down, come here, resistance. Okay, cool. That is top down. We're doing top down now, okay? As you can see from the previous example, we've got liquidity. So as you can see, there's the lows being made. We come down, took the lows, got back inside, rallied. We didn't go to the other side just yet. We needed to test the liquidity more. Once the liquidity came down, then got back inside, we rallied. to the other side of the range to take out this liquidity here. As you can see, this is swing highs. A bunch of stop losses were being built up to take out the other side of the stop losses. Okay, so we then go down to the hourly time frame. Once we are on this hourly time frame, this is the SR level, remember, on the daily. Then we can move it to this one here because we've got fresh price action. We're down below. You can take, this is a obviously this is our higher time frame level here from what I mentioned earlier. Let me make that a different color so it's very, very clear. There is the blue. That's the higher time frame level. The black is the most recent range. Then once we get back inside, there is the trigger to go long. We had another stop run and SR flip there. So this was where I was long in the markets and I had a stop loss below the lows. I did take a small position here as a risky one, but for this video, that's a bit of a advanced concept. Then I added the rest of my position in this range here. Once we had that liquidations cascade into this SR here, then the targets were up at the highs. So this was the exact trade that I took to make over $100,000. I posted this one on X and I posted it in my private community. So that was a very good trade for me. And that is the whole system put together. As you can see, we start from SR, then we move to step number 2, market condition. Then we move to 3, liquidity, then number 4, and so on and so on. As you can see, this example shows how traders get trapped, thinking that the market is going one way and then violently goes against them. Essentially, we make money off other people's mistakes. This works in absolutely any market. Forex, crypto, even if you wanted to trade orange juice. But you've seen how powerful this system is and how it's made me over $5 million across my trading career and how I've taught it to many other students in real time with the same success. And if you want to see this exact same trading system in real time, where I've used every example in this video, that many other traders have just simply copied what I do inside my private community called the Take Profit Collective. If you'd like to join and get access to my group and get access to every single trade I take before it happens, just check the description below. I can guarantee you it will drastically speed up your learning process with my real-time guidance in the markets. All the best.